This tutorial is produced on 2015, April 16th. This is the first tutorial on the quick financial calculators in the LifeGuide Professional Software. This particular tutorial is about commuted value. Commuted value is the net present value of a future series of payments. For example, it is the principal amount that is required to fulfill a desired series of predefined periodic payments, such as in a pension obligation, or, for example, as a death benefit that would be required to replace the family breadwinner's income, or to hire a homemaker and/or nanny to perform the duties of a stay-at-home spouse. Pension fund managers, for example, must therefore compute the commuted value in order to determine their reserve requirements. Likewise, life insurance advisors can use the same calculation in the process of determining the amount of life insurance, or critical illness insurance for that matter, that would be required. I should note, however, that just calculating the principal required to replace a breadwinner's income, or just the principal required to hire a homemaker or nanny to perform the duties of a stay-at-home spouse, is just part of the life insurance needs analysis process, but is certainly not a needs analysis in and by itself. So please keep that in mind. So we'll now proceed to the commuted value function. To do that, we first of all go to the green money bag icon at the main screen of LifeGuide. We click on that and we select multi-calc functions. And I'll say no in this case. And I'll pick commuted value. So let's say that we'd like to figure out how much in terms of principal or death benefit would be required to replace a biweekly income of $3,000. So we'll put, and we need that, let's say, for a period of 21 years. So we will put $3,000 in the periodic income field. Now, normally, and I should dwell on this for a second, normally the income that the family expects is not once a year. That would be silly. Either the family ends up having to starve for a whole year if the income is to be received at the end of the period, or they'll take out too much from the principal at the beginning of the year and start doling from that. Neither of these two would make much sense. So we should put things together to reflect the flow of income as closely as possible to the real cash flow of the income. So since in this case this example person is being paid bi-weekly, we'll change this to bi-weekly. And I mentioned 21 years, so let's put 21 years in here. And let's say that we'd like to stay fairly realistic and conservative, so let's assume a 3.5% interest rate. Let's say that we'd like to receive the payments, the income payments, at the beginning of each 2-week period, or at the beginning of each 2-week period, that is. We chose bi-weekly. And let's say that we want to also be realistic and keep pace with inflation. So let's assume that inflation over the next 21 years will be at, say, 2.5%. Once we've entered that, we instantly have the commuted value calculated for us. So if this was done for the purpose of replacing the breadwinner's income, we would need $1,482,087.19, if anybody is interested, to replace that income. That sounds like a very high number. So why don't we take a look at the details? And LifeGuide provides the details payment by payments, not just year by year, but payment by payment. So let's take a look. We'll click on details. And here we go for year 1. And there are 26 payments, because there are 52 weeks in a year, so every 2 weeks. And this is year 1, starting with 26th payment, 25th payment, 24th payment, and so forth. And we can see as this is the principal amount, or the commuted value amount. This is the payment, the amount of interest that's earned on the account, the accumulated interest over the time, and what the balance is at the end of each payment once the payment has been made. So we flow down, and there is the schedule right through the years for 21 years, payment by payment, all the way down. And I'll just scroll all the way down. And we see that overall this amount and the entire period, we've got at the last day of the 21st year, last payment, we are short just 75 cents, and that is as close as we can get as we use calculations going down to the 5th decimal place. Okay, the summary is up here. Periodic income of $3,000, starting off with $3,000, paid bi-weekly, going over 21 years, at an anticipated interest on the account value of 3.5% net. Payments are made at the beginning of each 2-week period, and we are indexing the payments at an inflation rate of 2.5%. And here is the verbal summary. If the periodic payments or income are paid bi-weekly for 21 years, and the anticipated interest on the capital is or is assumed to be 3.5%, then the startup capital required, or the amount of insurance, if this is for replacement of a breadwinner's income, the amount of insurance required would be $1,482,087.19. Thank you, and this concludes this particular tutorial.